There are no dips allowed in this stock market. Last week, I said it's buy the dips because of the post oversold psychology of trading. And the dips were hard to find this week. I mean, you had to be a day trader to even notice the stock market dipping. It has just ripped day after day after day until it has gotten now to overbought territory. All this FOMO action, fear of missing out, has taken market breadth right to the threshold of overbought. And if you've been following me or you read the blog, you know that this is a critical juncture. And I'll go over the chart as a reminder. But remember, this overbought into counter is not bearish. It's only bearish once the overbought period ends or the market fails to break through. And right now we're right at that threshold. And again, I'll go through the charts just to remind you about the implications of what's happening right now. Until that bearish moment, all Overbought says is that it confirms the strength and the urgency and the eagerness of the buying. And that's exactly what we've seen. I think some records have been set, or at least some historic runs have happened with the NASDAQ. I think this streak that the NASDAQ's been on hasn't been seen since, I think I heard on CNBC, since 2002. This is pretty amazing and urgent trading. And the thing to remember, in the last week I said this is post oversold psychology. It means that whatever happened to get the market to oversold is not what's going to take the market back down. And we've seen actually almost a mirror image of that trading psychology, which is no matter what the news has been. I mean, look, the port of Hormuz was supposed to have been open 9 days ago, and that's what supposedly relieved the market. And yet we've gone back and forth with headlines, it's open, it's closed, it's open, it's closed, or there's all these conditional opens and conditional closes. And even as I'm speaking now, I think the last headline I saw said the Strait is open, but the market actually hasn't cared much about these headlines at all. It, in fact, is looking forward to something much better. We don't know how far forward it's looking, but it sees something over the horizon that's better. And I've seen some commentators and pundits really lament, oh, the market is stupid. Oh, the market doesn't know what it's talking about. No, the market always knows what it's doing because price is all we have. I defer to price action. Yes, the fundamentals matter, the macroeconomics and all that stuff matter. But at the end of the day, it's the price action that pays, right? So pay attention to the price action. The market knows what it's doing at the end of the day. I mean, was the market smart when it was selling off and panicking in March, and now it's dumb because it's rallying and looking ahead to a better future? Or was the market dumb in March to sell off the way it did, and now it's smart to look ahead to the future? I contend the market is not dumb or smart. The market just is. And what is right now is a FOMO, fear of missing out market that is ripped day after day and is now at the overbought territory. All I'm looking at is now how the market reacts to these overbought conditions. All right, let's take a look at the charts. All right, this is the percentage of stocks traded above the 50-day moving average, what I like to call AT54 above the 50. Now you can see here we've had this strong V move. In fact, let's just make it clear here, right? We have gone from oversold just about straight up to the overbought threshold at 70%. Right now, my favorite technical indicator is at 69.2%. Now, like I said, we're at overbought territory, but it is not bearish. It just confirms the strength of the buying power. Now let's remind ourselves what happened the last time, okay? The last time we were in this situation, AT50 actually broke out above the threshold twice, but failed to close above it. And then finally, both times were actually bearish indicators. And I had talked about that for a long time, actually, as market breadth basically went straight down into the war. And of course, the war accelerated the momentum downwards in market breadth. So now this is why this next encounter is going to be critical, and I'm all about watching what happens here. So hopefully you know what my interpretation will be. I'm bullish right now, but if market breadth begins to fall away from here, I get bearish. If it gets back above, I'm fine flipping to bullish. I'm hoping the market doesn't flip back and forth. I actually thought the flipping back and forth would happen well under this threshold, but it is what it is. All right, let's take a look at the S&P 500 because this is also pretty amazing stuff. As a reminder, this purple line here is where the market closed the day after the first trading day after the war started, and that was around 68. Yep, 68, 81, 70. You could see when the ceasefire was announced, S&P 500 gained 2.5%. That's this arrow here. Cleared 200-day moving average with the blue line, cleared 50-day moving average resistance, that's the red line, and just continued to go straight up. And just one minor down day ever since. This past week, it's been no dips at all every day, just up and up and up and up and up and up. And now we're at all-time highs. So this is the market's in the clear. We're all bullish to go. That's all I could say. It's not really quite parabolic, even though the index is closed right at the upper Bollinger Band every single day. That's the Bollinger Band again defines the expected 95% of the expected price volatility around the 20-day moving average, which is that dashed line. The NASDAQ, similar story, straight up. In fact, it's even the urgency for the buying has been even more distinguished, more sharp because of the multiple closes above the upper Bollinger Band. Even today's big jump above the above the upper Bollinger Band has been pretty impressive. The double top that defined the bearishness of the NASDAQ is now over. That's right here. In fact, let me just go ahead and make sure it's clear that this point here invalidated the double top. So the NASDAQ is clearly bullish right now. IWM, the ETF of small caps. Just as a reminder, I no longer have my core position. I took profits in the previous week. So, of course, I'm lamenting a little bit to see IWM continue to rip higher. It's also at an all-time high. It's been bullish. It was only not bullish for one day, so it's been doing pretty good. And I have had success with trading some call options. I'm going into next week with some IWM calendar call spread. But the story is clear. S&P 500, NASDAQ, IWM, they're all bullish. They're all going straight up with barely any rest. In fact, no rest. It's ripping higher, no dips allowed kind of market. FOMO, fear of missing out, is all over the place. So this is, again, when the market is this hot and overbought takes on even more significance. So that's what I'm going to be watching so closely in the coming days and weeks, regardless of what is happening in the news. All right, let's take a look at the VIX. Actually, before we go into individual stock charts, just as a reminder, the VIX already broke down below. You see this box here, this blue box, defined the churn that after the VIX did its blow off top. Once it broke down below that box, the fear basically dissipated from the market, and the VIX, just as the market's been going straight up, the VIX has been going straight down. And so the VIX is all on board with the bullish sentiment in the stock market. All right. Of course, with the war being less of an issue, that means oil has come off. Now, oil actually is not as low as you would expect. Of course, there's been a lot of infrastructure damage. It's going to take a while for oil to get back to whatever the new normal is going to be. So it's interesting to see that after the ceasefire, oil, yes, it lost. And USO, ticker symbol USO, the United States Oil Fund, is kind of a proxy combining Brent and WTI. Now, it closed 9.8% on the day after the ceasefire, but it did rally off of its low. And it actually stayed elevated that entire time because there was a lot of uncertainty about whether the Strait of Hormuz is actually open. So that had a very direct impact on the price of oil. I mean, that was very real. But the market didn't care and just kept going straight up. Now, with Iran, with other news confirming that the Strait of Hormuz is open and news that a deal is imminent and on and on and on it goes. USO fell again. Now this time 7.8%, but you can see it rallied strongly. Let's zoom in here. Rallied strong off the lows here. So it's not totally clear how or when oil is going to get back to a new normal, but it is starting to come down. And that's, of course, whenever oil comes down, it's going to provide an additional boost for the stock market. There's some other impacts of the Strait of Hormuz being open, or at least the market more confident that it's open. The fertilizer trade is essentially over. This is Lyondell Basel Industries, ticker symbol LYB, plunged 12% right here, broke down below the 50-day moving average. So that is bearish for the fertilizer trade. I assume it's essentially over at this point. Now we have, it's interesting that with oil coming down, a lot of the other commodities have gone up. It's sort of like they're on this seesaw where one is up and the other one is down and so on. FCX, ticker symbol FCX, this is Freeport-McMoRan, essentially an iron ore producer, has broken out to all-time highs. I did get back in to FCX. I did get out as part of my risk management back in March on the 50-day moving average breakdown. But now I'm back in, and I'm glad to be back in there. I got into other commodity plays earlier in the month. And then silver, I'm back into silver. This is ticker symbol SLV for the iShares Silver Trust. It broke out above the 50-day moving average. I'm just following the technicals here. SLV jumped 3.4%. You could see the breakout here. And, I'm just basically playing a breakout trade. Nothing more, nothing less. I don't have an opinion about silver beyond that, except for that it should be following other commodities on up higher. Now, of course, a lot of things that depend upon commodity prices benefited this week. I won't go through all of them. Expedia is a good enough example, ticker symbol EXPE. Now, somehow I missed this. This is actually one of my big missed trades of the week. Expedia jumped on Monday by 5.3%. It totally confirmed, again, let me just make it clear here what I'm talking about. Talking about this move right here. It completely cleared this converge support and resistance, depending upon what side of the line you're on. And this was a big bullish move. I should have been buying anywhere along this line. Even at the close, I should have bought. And you could see the resulting move. Expedia just kept moving up higher all week, closed above its upper Bollinger Band all 4 days. Even had a dip here that I could have bought, and I didn't get in. So that's a really big miss for me. And there were other oil-related or oil-impacted trades that I did miss. One interesting trade where I tried to go contrary, kind of like a hedge against all of my bullishness, was on Best Buy, ticker symbol BBY. Goldman issued a sell rating, and it gapped the stock down that day 2.4%, and that happened to be the low. And I just watched Best Buy just rally straight up with the market, and thinking at some point Goldman's thesis on why they downgraded to a sell should come into play. I bought just one single put option, and obviously it looks like that put option is just going to be wasted because Best Buy has basically confirmed a 50-day moving average breakout here, and it's looking like it's about to make a bearish to bullish reversal. So I may go into next week and buy shares of Best Buy at this rate, but I'll keep the put option in there because I definitely want to hedge, because Goldman may have very good reason to have issued that sell rating, even though it turned out to be right at the bottom. Nike, of course, another retail name. It's oil dependent just because with gas, if gas prices come back down, consumers have more money to spend. But the biggest news for Nike here, ticker symbol NKE, is that the CEO of the company, director Tim Cook, you know Tim Cook from Apple fame, he's the CEO of Apple, and I think other insiders bought shares, a lot of shares. Of course, for all of them, I think the amount they spent was pretty small for their pocketbook, but the amount of shares is pretty significant. I followed in line here. This is a classic bottoming move even. Let me just draw a quick rectangle so you can see it clearly. You can see just this congestion area right here. See that box? The news of the insider trading popped the stock above the box, and now it's starting to work on its post-earnings loss. I think the move is going to be very slow because let's remember, Nike has been on a vicious, vicious downtrend since peaking in 2021. It was as high as, let's just call this 176, and it's all the way down to 46. So there's been a lot of pain, and I can imagine that a lot of people are very tentative about buying back into Nike. I don't consider this a rebound that's going to happen fast. It's going to be slow and dragged out, probably a lot of setbacks, but I still want in, and I expect to be holding these shares for quite some time. All right. This one I have to, it's a retail name, or used to be retail name. It's actually now an AI name. I have to show it though. This is Allbirds, ticker symbol BIRD. I believe last month they essentially went bankrupt, sold their assets for a song, as they say. And this month, Wednesday, news came out that they're converting to an AI company, basically a neo cloud type company where they're going to buy infrastructure and lease it or rent it out. Stock soared 582% that day. This is really emblematic of the all-out bullishness that's going on in the stock market. It confirms that speculative fever is back, and anything and everything could get bought up. Now, there is some rationality coming into play. The stock came back down 35.8% the next day. It only came down 1%, but this is something I'm not going to chase. I mean, this company flipping from selling shoes to being an AI infrastructure company is quite bizarre. But given I am into the AI trade, I will keep an eye on it. All right. Tesla also confirmed the return of animal spirits. As a reminder, all year long for 2026, Tesla has been in this downtrend, mostly defined by the 20-day moving average, this dashed line. And it finally broke out above that with a big surge on Wednesday, 77.6%. It stalled briefly at 50-day moving average resistance and then broke out to 200-day moving average resistance and stalled around there. You can see this. You can see this big intraday move up to about 409.58 and then a big fade back. So let's see if Tesla can hold. If it goes below the 50-day moving average again, I'm going to assume the downtrend is back in place. And if it can close higher, then it's bullish. Right now, I got a small bearish position with the with TSLQ. All right, since we're talking about the big cap tech stocks, let's go into MAGS. It's interesting. Even though the NASDAQ is in all-time high territory, the MAG 7 are not as a group. They have a lot. They still have some ground to gain. As a reminder, just like Tesla, the MAG 7 had been in this steep downtrend all year. It preceded the war. The war only accelerated it. And now MAGS is looking good again, right? And you can see the ripping higher. People rush back into MAG 7. I really thought that with all that money moving into MAG 7, that there wouldn't be a lot of money for the rest of the market. But so it's very impressive that even with this big surge, a lot of the other rest of the market was also able to surge higher. Amazon was one of the biggest contributors to this big surge. You could see it went straight up. And it didn't quite close at an all-time high, but it looks like it's getting ready to do so. I had a decent position on. I think I bought it somewhere back here in the lows. This is the kind of rip that I have to take profits on. I don't want to count on this being held. Again, it's not a bearish statement. It's just, again, risk management, want to lock in some of those profits. Now let's move on to semiconductors, which have been really hot. AMD, Advanced Micro Devices, I really thought it was going to stay stuck in a trading range for quite some time. Big time breakout above the double top from the all-time highs. On Thursday was the big move higher, 7.8%. So this is definitely buy the dips again. I did well trading within the trading range here. And actually, I guess I said that Expedia was my big miss. Actually, I think if I really look at this now, AMD is probably my big miss because this move right here confirmed the 50-day moving average breakout. And even with the looming double top, this was still worth some speculating to buy to see whether it could at least rally to the double top. And if I had done that, I would have been in the stock for the big breakout. But, that's how it goes. I wasn't there. But AMD stays on my radar. Intel's another one that I missed. Actually, I already talked about how this was a big miss earlier. As a reminder, it confirmed a 50-day moving average breakout. This was in the previous week. Let me put a circle around there. That's the point at which it confirmed. It has been ripping higher. It's now near a 26-year high. Pretty amazing. The presumption that I have is that, I haven't seen any news to explain this. It's just price action. And I believe what's happening is that there's such a capacity crunch with chip manufacturing that anybody with a fab is going to get attention and get some love. And I think Intel is benefiting from that. So now it's near a 26-year high. I'm a fan of the stock, and I want to buy the dips if the market will allow any dips. Again, we're in this no dips FOMO market, so who knows when the next dip of any size is coming. Now, AI, all of these semiconductor stocks are pretty much being driven. The big tailwind has been with AI. Dell is a PC company that's also benefiting. Um, and the big rumor happened on to start the week that Dell, Dell jumped 6.7% on Monday with rumors that NVIDIA is in advanced talks to buy a PC company. The rumor, there are only a few PC companies left, so Dell is one of them, and it jumped. But the interesting thing was it faded the entire move very quickly, despite the rest of the market going up. And I think this is just a matter of the stock had already been in such a bullish mode since February when it went up 21.8% here for earnings. So I did something different, which is, typically I'm not going to chase these moves, but I realized what I should do is that I sold a put. I think I sold it around the 180 mark. No, wait, 170 mark. Sorry, I can't quite remember. But that actually worked out pretty well, even though I got a little nervous with this complete reversal of the move. And my logic was that even if the rumor turns out not to be true, Dell is still in this very nice uptrend with the 20-day moving average that's still building off of earnings. And at all-time highs, it's confirmed the bullishness. So I wanted to be there. If I could get in for Dell at 170 or wherever my strike was, I would still be happy with that because Dell was a stock that I got shaken out of earlier. I think it was earlier in the year. Yeah. So I wasn't participating in a lot of this move. Now this put helps me catch up a little bit. All right. CRDO, ticker symbol CRDO, CRDO Technology Group. I talked about this before, this rounded top that looked like the stock had tired out. Well, Jefferies issued a buy rating on Monday. The stock soared 12.4%. Broke out. That's a bullish part. That was a bullish point here. I was hoping the stock would take a rest and let me get back in, but no. The market followed it with even more trading volume the next day, soared 18.7%. So it's kind of hard to chase a stock. It's already up to this point. It had already made a nice big move off the lows. So now I just have to wait for some sort of rest to a key support point. Maybe the only support the market will allow is it getting back to around 149.50, which is the intraday low of this move here. All right. And then Vertiv, since we're talking about technology, still my favorite stock, even though I'm no longer in it. I took profits. Vertiv Holdings, ticker symbol VRT, broke out to a new all-time high on April 8th when the ceasefire was called, and the stock has had decent momentum. It did stall out a little bit. I'm not expecting Vertiv to get much higher, but let's see what happens when it reports earnings, I think, next week. And I've talked enough about Vertiv in the past. You can check out past videos on that one. Hood is a miss. It's an understandable miss, but you can see here Robinhood, ticker symbol HOOD. This is the nice 50-day moving average breakout. I wanted to see confirmation, but unfortunately the confirmation came on a huge gap up the next day of 10.4%. Can't really chase that. I tried. I put in a buy, I think around 84. The stock just missed it that day. And even at 84, I wasn't comfortable, but I was thinking I'm risking missing the move. That turned out to be correct. I didn't have that trade in place when Robinhood hit 84 the very next day, and now it's way up to 90.75. It actually got as high as 93. But anyway, I think let's take a look back here. I think Robinhood is making the turn now. It's not quite bearish to bullish, but you can see it was a very broken stock for quite some time, and it hasn't really participated in the entirety of the war relief move. But I think Hood is making a turn. And while I'm talking about Hood, let's look at Robinhood Ventures. I went ahead and bought a long term. This is an interesting one. This is ticker symbol RVI. This is an interesting one because the IPO is at 25. The stock, it's a closed-end fund. It opened well below that, but then rallied, and then it soared on March 25th when Fundrise came out with its own innovation fund. And you could see here that RVI, it soared big time, but then also faded back that entire move. So that's why I'm just going to buy this. I'm just going to hold it. It's got some companies in there I really like, Databricks in particular. And, it's a new wave of investing. Let's see how it works out in the coming months and years. All right, let's get to some bad news. There's got to be bad news somewhere, right? This is Netflix, ticker symbol NFLX, fell 9.7% on earnings. I think the biggest disappointment was that CEO Reed Hastings is going to, he's stepping down from the CEO position, but he is, I think, going to still be on the board. I think this selling is overdone. But of course, Netflix had been suffering for quite some time. So there could just be, this is like a disappointment trade. You had this breakout above the 200-day moving average. It suggested that only good news is to come, and that isn't what happened. It wasn't all good news. I don't want to buy here. This is where I sold Netflix on when I took profits on playing them stepping off of the bid for Warner. So I would prefer to see the stock drift into a test of the 50-day moving average. That's where I want to buy it. So that's around 92, 93 or so. But we'll see if the market allows it to happen. This is one of those rare dips in a market that in a no dips market. And then finally, we have UNH, UnitedHealth Group. So healthcare stocks are coming back around. I think I talked about this last week, or at least I wrote about it last week. I was waiting to see what would happen at this 200-day moving average. You could see that the stock was kind of wavering. It looked like it could come back down. I was thinking I might get an opportunity to buy UNH at 296 or so. Instead, it broke out above the 200-day moving average, and I didn't hesitate. At that point, I just bought. So you can see sometimes I miss these breakouts, and sometimes I'm on point and on alert. This is one of those times when I was on alert, and so far so good. Of course, UNH is not really an exciting stock. It's not going to jump 5, 10, 15% a day. And this is going to be, I'm trying to keep this as a long-term hold. All right. So let's just review with this chart of the S&P 500. This is so far a no dips market. FOMO, fear of missing out, is in full effect. We've gone straight up. It's very hot, but the market is overbought. This is AT50. We're right at that threshold. If it comes back down, if it drops from here, it's bearish. If it breaks out above the 50-day moving average, we'll finally have what I like to call overbought trading. So this would be overbought trading. And again, overbought trading just further confirms the bullishness of the market, and we don't get bearish until that overbought period ends and market breadth starts to come back below. One thing I forgot to show was AT200, which is the percentage of stocks trading above their 200-day moving averages. You could see that unlike AT50, this longer term view of market breadth hasn't quite confirmed the move. It's still just at 58.5%. So I'm a little wary of this. It's not enough to take me off the bullish podium, but just remember that the long-term damage in the stock market is still there for 42 or so percent of the stocks. And, we want to see at least another 10 percentage points back up, regain their 200-day moving averages to get really confident that the bullishness is as strong as it can possibly be. All right, so that is it. One quick update on the NASDAQ. Turns out that the 13-day winning streak that it's on is the longest since 1992. So just want to put that correction in there. All right, thanks a lot for checking this out and hanging in there this long. As a reminder, please like and share this comment so the algorithm knows what's up. If you have questions or comments, put them down below. And as always, I highly recommend you subscribe so you can get alerted to this content in the future. All right, thanks for checking this out, and I will see you the next time.